Welcome to The Explainer. Listen, today isn't about stock tips. It's about something much more valuable. We're going to build, from the ground up, the entire mental framework you need to think like a truly great investor. We'll use these slides to lay it all out, piece by piece.
You know, this quote it nails it, doesn't it? The market, a lot of the time, feels completely irrational. It's this chaotic mix of fear and greed. And here's the thing, that chaos, that's where the opportunities are. But it's also a minefield where a lot of people get wiped out.
So how do we navigate that minefield? Well, we've got a 5-part framework for you. We're going to start with the 30,000-foot view, the economy itself, and then we're going to drill down layer by layer all the way to the specific choices you make as an investor.
Okay, let's dive in. Section 1, the engine of the economy. Look, before you can even think about finding value, you've got to understand the machine that makes it all go.
It all boils down to this one simple thing, a transaction. Seriously, everything starts here. Think of it like a single atom. It's the absolute fundamental building block of the entire economic universe. You buying your morning coffee? That's a transaction. A private equity firm buying a company? Same thing, just with more zeros.
And here's how it all connects. Those little atoms, the transactions, they don't exist in a vacuum. They clump together to form molecules. We call those markets. You've got the market for cars, the market for houses, the stock market. And when you add up all of those transactions in all of those markets, boom, you get the whole shebang, the economy.
Okay, so we've got the basic mechanics down. We understand the machine. But now we need to talk about the ghost in the machine. You know, the human element. The raw emotion that can make prices go haywire, completely detached from how the actual machine is performing.
So the market really does move in seasons, kind of like farming. You know, you don't plant your corn in the dead of winter, right? Well, it's the same idea here. You probably wouldn't go all in on things like car companies or fancy watch brands, what we call cyclicals, when the economy is in a nosedive. Getting a feel for this natural rhythm is a huge part of reading the market's mood.
And check this out. It's a perfect example. Within just 1 year, Amazon's stock price swung by nearly 50%. Now you have to ask yourself, did Amazon's actual business, all those warehouses, their cloud computing services, the whole operation, did its real value change by 50% in a year? No way. Absolutely not.
This gets to the absolute core of smart investing. You have to learn to separate two things. The market's price, which is like a moody teenager, up one day, down the next, and the company's actual business value, which is much more stable. The real pros, the great investors, they make their fortunes in that gap between the wild price swings and the solid underlying value.
So, if our goal is to find that real value, where do we even start looking? Well, that brings us to Section 3. We're going to zoom in past all the market noise and focus on the individual company. We're on the hunt for what you might call a competitive fortress.
Yeah, the really legendary investors, like Warren Buffett, they aren't just looking for a good business. They're looking for a castle, an impenetrable fortress. And every good castle needs a moat, right? A deep, wide moat that's impossible for invaders or competitors to cross. This moat is what protects the company's profits year after year. So, what are these moats actually made of? First up, you've got the sheer power of size, a scale advantage. I mean, think about Google search. The more people that use it, the more data Google gets. That data makes the search results better, and better search results bring in even more users. It's a beautiful cycle for Google, but it's an absolute nightmare for anyone trying to compete. How do you even begin to fight that?
All right, another type of moat is what we call switching costs. Basically, the product is sticky. It makes it a huge pain for customers to leave. Imagine a big corporation that spent a decade and millions of dollars building its entire operation around a specific piece of software. Even if a slightly cheaper, slightly better competitor comes along, are they really going to rip everything out and start over? Not a chance. The hassle is just too big.
Then you've got brand loyalty, and this is a huge one. It's so much more than just a cool logo. It's about decades of trust. It's that feeling you get when you see a certain name. A new startup can come along with a fantastic product, but what it can't do is magically create 100 years of customer trust out of thin air.
And last but not least, some moats are just giant walls of money. Some industries have a price of admission that's so ridiculously high that almost nobody can even afford to try and compete. I mean, you're not going to just decide to build a new railroad network tomorrow, are you? Or a brand new chip factory. The upfront cost creates a natural barrier that protects the big players who are already inside.
Okay, so let's say you did it. You found a company with a great moat. That's awesome. You found a fortress. But is it a fortress that's expanding its kingdom, or is it just sitting there? Finding a durable business is only half the battle. Now you have to figure out if it's a growing business.
The best growth companies all seem to have a similar kind of DNA. They're playing in a growing field like AI or clean energy. They're obsessed with creating new products. Their R&D actually leads to more sales, and this part is absolutely key. They can scale. Just think about it. For a software company to sell one more copy, it costs basically nothing. For a restaurant to serve one more customer after it's full, it needs a whole new building. That's scalability.
So you find a company that seems to tick all these boxes. Fantastic. But don't pop the champagne just yet. Now you have to put on your detective hat. You have to become a skeptic and really kick the tires on that growth story. You have to ask the hard question, is this even remotely believable? And this is one of my favorite ways to do that. It's a simple sanity check. Just take the company's current amazing growth rate and run the numbers out for 10 years. What you often find is that a story that sounds pretty good today suddenly becomes completely absurd. It's a quick way to see if the hype has gotten out of control. You have to do the math.
All right, we're on the home stretch. In our last section, we're going to talk about the psychological traps, the common myths and mistakes that trip up even the smartest people. And we'll give you a super simple framework to help you avoid them.
First off, you have to know what kind of game you're watching. For the last couple of decades, the Silicon Valley playbook has been something called blitzscaling, and it's totally different from old-school business. The old way was make money, then try to make more money. Blitzscaling is lose a ton of money to grow as fast as humanly possible, crush all competition, and then maybe figure out how to be profitable later. It's a wild, high-stakes gamble that can create giants or just giant craters in the ground.
And that leads us to what might just be the golden rule of investing, courtesy of the legendary Charlie Munger. It's simple. You have to know what you're good at. You have to understand the boundaries of your own knowledge, and you have to stay inside your own circle of competence. If you don't have an edge in the game, don't play.
So here's the ultimate tool to put that into practice. It's a simple 3-bucket system. When you look at any investment, it can only go into one of 3 piles. There's the yes pile, you get it, it looks good. There's the no pile, you get it, and you want no part of it. And then there's the third, and honestly the most important pile, the too tough pile. The real secret weapon of a smart investor is the humility to say, you know what, this is just too hard for me to figure out, and then just walk away. So I'll leave you with this question to think about. When you're honest with yourself, how big is your too tough pile?